Hello and welcome everyone to another StashAway market commentary. With me today, of course, our Deputy CIO, Stephanie. Stephanie, how are you doing?
I'm good. How are you, Philipp?
I'm very well. How is Hong Kong doing these days?
It's getting slowly but surely back to normal. So today, restriction on mask for exercising outdoor has been lifted. So yeah, no mask running.
That's really good, especially running. It's getting hot
Exactly.
too, right? So, no,
Exactly.
that's good. Yeah, everyone, we have obviously lots to talk about since 2 weeks ago. 2 weeks ago, we actually kind of like were anticipating. Today, we're recording this on the 5th of May Asia time, and what happened overnight was we had the Fed make their statement and hike interest rates overnight by 50 basis points. So, Stephanie, with that being said, do you want to explain a little bit, go back and a little bit explain why they are doing it, kind of what the language was, and obviously we saw on in U.S. hours as soon as the announcement was made and Chairman Powell was giving his remarks, markets shot up, best day since November 2020, right, in the stock market. So maybe you can give us a little bit of more background on all of this.
Yeah, the market's been extremely choppy. So I think we've the starting point was a very, very, I guess, like kind of oversold market. And if you just look, kind of zoom out a little bit, you realize that actually it just did a round trip in 2 weeks' time. I think just a bit of background or kind of taking a step back as to what the Fed did overnight. There was a 50 basis point rate hike announced, and that was, I think, the first time we've had a 50 basis point hike for a long time. However, the reason why the market actually reacted quite positively to it is because it was well telegraphed and it was actually well predicted by the market, and because actually there is instruments that are tradable on the market that basically asset managers use to kind of hedge or bet as to how the Fed path is going. And I think even before the Fed hiked 50 basis points, the market was already looking for a hike to almost a kind of 2.8 or 3% by the end of the year. So 50 basis point hikes was very, very well expected, and the Fed just delivered that. And they didn't go like overly hawkish in the remarks. So market, of course, have a tendency to be quite choppy when there's uncertainty. But when like kind of certainty comes in this case, I mean, the Fed kind of delivering what the market was expecting, then I mean, the market basically settled down and reacted nicely to it.
Did you see the same thing happening or what's happening in the bond market? Because obviously this year has been not what people, like when they look at their diversified portfolios in general, right? They say, like a 60-40 equity bond portfolio is also down quite a bit, right? Because bonds have also been selling off since the beginning of the year. So it's very like a unique way to look at things. So with the rate hike, what's the bond market telling you?
Yeah, I mean, if you look at bonds, a lot of people may not notice, but adjusted for volatility, I mean, bonds actually are the worst performing asset class this year, even worse than stocks. The reason of this, of course, is because of inflation, and given inflation, the Fed has to hike rates, and that like when yields go up, bond prices come down. So if you look at, like, for example, what Philippe mentioned, like 60-40 portfolio or a risk parity portfolio, i.e., kind of asset allocations between bonds and equities, the drawdown was actually very, very significant. To the tune of actually, if you look at risk parity funds, they were down almost like 19-20%. And this was on the same scale as COVID. So it was a really, really big shock. Of course, if you look at the market right now, the bond market is pricing in a 3 percentage point hike towards the end of the year. But if you look at 10-year, it's also close to 3%. So the yield curve is actually pretty flat. And secondly, if you think about, how high can yields actually go further? There are a few indicators that you can look at. For short-term yields, of course, it's kind of the neutral rate that the Fed has been referring to. And for people who actually have not heard about the neutral rate is basically a estimate by economists and by the Fed as to the rate at which the Fed will not be expanding or contracting the economy. So basically, think about it as a target rate for the Fed to hike to. And the Fed actually publishes this on during the minutes and the meetings. And right now, I mean, that neutral rate sits around 2.6 to 2.8%. So the Fed basically will hike to that neutral rate by the end of the year. Secondly, if you have to think about kind of longer term bonds, so for example, 10-year bonds, like what is their fair value or where should it settle, you can also look at longer term inflation expectations. So right now, long-term expectations is also sitting around like 2.5%. So given that the market or like 10-year treasuries are trading close to 3%, again, it's quite well priced in. So hence, I mean, in recent weeks, we've actually seen some stabilization in the bond market. And I think that is a kind of requirement for asset prices or for asset classes to actually start to stabilize.
Yeah, no, thank you, Stephanie, because you kind of already talked about my question. Next was what's next for the Fed, and I think you kind of already kind of told us this with this neutral rate. So I think that's great. So then let's move on from the Fed. We talked about it a couple of weeks ago as well, but I think it's good to rehash and see where the situation is at this moment. Obviously, a few things happened in China, right? They also talked about the rates. We also had still a lot of lockdowns and productivity in factories down and also at ports, right? Which obviously just exasperates the current world situation of this whole inflation part, right? Because things are not moving, things are not coming, people are waiting for products, people waiting. So this drives prices a lot higher. So any update on this and where you see this going over the next few weeks, months?
Yeah, I guess I mean, sitting in Hong Kong, like a lot of other cities in China, particularly the coastal city, the big cities in Shanghai, Beijing, they're going through what we went through in the past 3 months. And basically, I mean, you see lockdowns in all these major cities. Again, as Philippe said, I mean, blocking major kind of trade ports and really, I mean, really, I guess the bigger impact is that it stops economic activity in China. So I think if you think about the Chinese policymakers, they have a very, very difficult choice because the stated goal for this year is to have 5.5% GDP growth. But they also have another goal of reaching COVID zero. And these two targets are not really compatible with each other with the recent COVID outbreak. So I think, I mean, ultimately something has to give. And I mean, we've seen some signs. For example, last week or the week before, there were some loosening and there were some rumors about relaxing restrictions on like internet companies, etc. So perhaps like the policy choice for them is to relax or stimulate the economy a little bit so that it doesn't go into recession. But we'll have to see because we haven't seen very, very strong kind of policy reactions. And I think the third goal, which is a much longer term goal, is for the Chinese economy to deliver. So we won't see like a big style stimulus because that would contradict with the longer term goal as well. So having said all of these, I think, of course, I guess because the supply chain is blocked, so it pushes up input prices, etc. But there's also a silver lining to this because I mean the Chinese economy is basically going to suffer in Q2 because of all these lockdowns. And if you think about kind of deflationary forces, this will be one big deflationary force globally. So it actually may help US from the inflation fund or globally in the inflation fund.
Yeah, no, that's a good point of view. I like that. Let's see how it plays out, and we'll definitely obviously be monitoring this. But I like that point of view. That's a little bit different than everyone else, so I like that. Last but not least, Stephanie, obviously this year showed again the strength of the US dollar when it comes to turbulent times, right? US dollar is at all-time highs pretty much against most currencies, I think, except the Brazilian currency as well as the Russian currency
Ruble.
by now. Exactly, which is funny because we were just talking about this before offline, how the ruble has recovered. It's literally like this, the chart, right? Literally goes up and goes straight down. But with the US dollar at all-time highs, what's kind of your view on this and how, the impact on people's portfolios as well, right?
Yeah, I think the ruble is a very specific case in which, I mean, basically Russia tells everyone to buy the oil and gas in ruble. But if you look at all the kind of across all the major currencies, actually, I mean, they all weaken towards US dollar, and actually the US dollar versus other currency is at a multi-year high. And I mean, most recently, even renminbi, which has been strong, has started to depreciate. And I think given like the volatile kind of macro environment, I mean, US dollar traditionally and still is serving as a kind of safe haven currency that people would gravitate towards. So it actually shows the benefit of having diversification away from your home currency. When these turbulent times, actually having US dollar exposure helps to offset some of the kind of drawdowns in assets and helps to stabilize your portfolio. So again, let's watch kind of how the macro unfolds. But I mean, remember to just kind of have a diversified portfolio of currencies and also asset classes to help you to navigate through these difficult times.
Yeah, no, that's great advice. Thank you, Stephanie. And for everyone else, we have a few events coming up in Malaysia as well as in our MENA region. And the first one is in Malaysia. That's called How to Invest the Right Way with ETFs. That's Wednesday, the 11th of May, 6 p.m. local time. So if you want to sign up, as always, there's the links in the show notes below. And you can also find them on our website and everywhere else you interact with us. And for our MENA region, we have a pretty exciting chat there. It's called our StashAway Money Chat. It's called How Financial Education Can Lead to Financial Freedom. That's again, Wednesday, 11th of May, 6 p.m. local time. So we're looking forward to seeing as many of you as possible there. Stephanie, I wish you a wonderful day ahead. And we'll speak again with everyone else in a couple of weeks. Thanks so much.
Thank you.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.